Welcome to our channel. Today, we're discussing the recent stock market collapse and its implications. The American economy's heavy reliance on asset prices makes it vulnerable to sustained drops. We'll explore what triggered the current turmoil, what the Fed fears most, and what this means for the future. Market carnage and immediate triggers. Markets are in turmoil, with Japan's Nikkei 225 plunging over 12% on Monday, the Dow dropping around 1,000 points, and the Nasdaq falling nearly 4%. The sell-off began with Friday's disappointing U.S. jobs report, igniting recession fears. The AI trade, once hot but now overly leveraged and overhyped, has also soured, leading to a tech stock bloodbath. The breaking of the dollar-yen carry trade. A significant factor in the market collapse is the breaking of the massive dollar-yen carry trade. Investors were borrowing cheaply in yen and investing in higher-yielding U.S. assets. The Bank of Japan raised rates on July 31st and signaled more hikes, causing a massive capitulation in these positions and leading to margin calls. This created more selling pressure as investors sold other assets to meet these calls. The role of the Fed and market expectations. Predicting short-term market movements is challenging, but understanding the broader context is crucial. This situation is a classic positioning unwind rather than a response to an economic shock. Equity investors chased the tech bubble too aggressively, borrowing cheaply in yen, and now face margin calls and forced liquidations. The key to understanding the current turmoil lies in the Fed's next steps and the market's perception of them. The Fed kept interest rates on hold in July, but hinted at a rate cut in September. Analysts believe the Fed has waited too long to lower rates after post-pandemic hikes aimed at cooling inflation. Market expectations of interest rate cuts had already been rising, but the recent market meltdown has accelerated this. Investors are now pricing in about 55 basis points of easing at September's meeting and 100 basis points by November. There's even talk of an emergency rate cut, reflecting a belief that the Fed needs to rescue the markets. The Fed put and the financialized economy. The belief in a Fed put, the idea that the Fed will intervene to stabilize markets, is widespread. This perception has fostered confidence in the U.S. stock market since the late 1990s. The Fed has shown a readiness to intervene whenever financial market stability is threatened. This invisible commitment to markets stems from the highly financialized nature of the U.S. economy. Asset prices are crucial to the wealth of many Americans, particularly the elite. A sustained market drop would be catastrophic, impacting GDP and even tax receipts, which are dependent on capital gains. Market instability is the Fed's biggest fear. It will entertain short-term measures and introduce moral hazards to keep markets stable. Stocks have become a tool for America's wealthier classes to counter inflation, exacerbating economic inequality. Looking ahead, the apocalypse is likely not imminent. The Fed can reinflate stock markets through money printing, making a stock market collapse unlikely. The real question is at what cost? Impacts on the bond market, inflation, and currency stability. In the coming weeks and months, watch how seriously the Fed takes market volatility and how much the market pressures it to act. The Fed's actions will reveal its true priorities. The recent market collapse highlights the fragility of an overly financialized economy and the Fed's crucial role in maintaining stability. Understanding these dynamics is key to navigating the current turmoil and anticipating future developments. Don't forget to like, share, and subscribe for more insights on global financial events. Stay tuned and stay informed.